Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Crowdstrike.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saves screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets.
Right.
Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list and comes down to about $14.93 per month when billed annually after the discount. StockAnalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
All right, let's move into the wealth building context. If you're managing a portfolio right now, you've likely watched this stock's incredible run, and you're probably wondering, if you're just too late to the party.
Yeah, exactly. I mean, our deep dive today is really about answering one critical question. Is this just a cyclical tech stock, temporarily inflated by an AI bubble, or is there a durable multi-year compounding engine here?
Right, a stock you actually need to own for the next decade.
Yeah.
Because to figure that out, we have to grasp the seismic shift happening in corporate IT budgets right now.
Oh, it's a massive shift. 10 years ago, cybersecurity was treated as a discretionary expense. A company just bought whatever legacy antivirus software they could fit into their leftover budget.
Basically an afterthought.
Exactly. But today, it is an absolute non-discretionary necessity. You do not cut your endpoint security budget when macro conditions get tight.
Because the cost of a single data breach is just catastrophic, both financially and relationally.
Right. And right now, CrowdStrike is widely recognized as the apex predator of this endpoint security landscape. They are actively dictating how enterprise defense evolves in the age of artificial intelligence.
Okay, so I agree the sector has become non-discretionary, but I kind of want to rethink that apex predator label. It sounds aggressive, but it doesn't really explain how the tech works. I mean, there are plenty of legacy competitors out there offering protection. What makes this specific company a compounding moat?
Well, that comes down to their architecture and the network effect it creates. Think about how a traditional legacy antivirus operates, right? It installs this heavy program on your laptop and just checks your files against a known list of bad code.
Right, which is inherently reactive. You only catch the virus after it's been identified somewhere else, added to a list, and then downloaded to your machine.
Exactly. CrowdStrike completely flipped that model. They use a single-agent, cloud-native architecture.
Meaning they deploy one incredibly lightweight sensor on a device instead of relying on a static list.
Yes, and it constantly streams telemetry data back to their AI models in the cloud. We're talking trillions of events every single week.
So it functions much less like a predator and much more like a global immune system.
That is the perfect way to look at it, because they are processing those trillions of events globally. The moment a brand new threat is detected on a single laptop in London, the AI instantly analyzes it. It learns its behavior and creates an antibody, so to speak.
And then within seconds, every single device on the CrowdStrike network,
Whether it's in Tokyo, New York, or Sydney.
is protected against that specific threat.
Exactly. Every new client makes the product smarter and safer for everyone else. That creates a compounding data advantage. A legacy competitor simply cannot replicate that global immune response without basically tearing down their entire company and rebuilding from scratch.
Which no legacy provider is really willing or able to do quickly.
No, they're not.
Well, that global data moat sounds impenetrable in theory, but, theory doesn't always pay the bills. Now let's look at the fundamentals to see if that AI advantage is actually showing up in the bottom line.
Oh, it's definitely showing up.
Because as an investor, you need the hard numbers to justify the premium this stock commands. And looking at their fiscal year 2025, they are definitively making the transition from a growth-at-all-costs startup into a highly efficient profitability machine.
Yeah, the top-line momentum alone is stunning. I mean, they closed out the fiscal year with revenue hitting $3.9 billion. That represents a 29% year-over-year growth rate.
Which is incredibly rare at that scale.
Mm.
In the software industry, investors often look at the rule of 40.
Right, the idea that a software company's growth rate plus its profit margin should exceed 40.
Yeah, hitting that metric is the gold standard. To be approaching $4 billion in revenue and still compounding top-line growth at nearly 30% puts them in extremely elite company. And their annual recurring revenue, or ARR, surpassed $3.8 billion.
And that recurring revenue is their lifeblood. But
Yeah.
here is what investors are really watching, the operational leverage. Because heavy R&D spending is just a harsh reality in cybersecurity.
Yeah, you have to spend massively to stay ahead of state-sponsored hackers and, well, automated AI threats.
Exactly. But despite that heavy R&D burden, their GAAP operating income actually turned positive in fiscal year 2025.
We should clarify for people that GAAP operating income means the strict, generally accepted accounting principles. This isn't the adjusted make-believe profit that tech companies often report by stripping out their stock-based compensation.
No, this is actual rigorous accounting profit. That milestone proves their cloud-native model possesses massive operating leverage. Once the core software infrastructure is built, the cost to add one more subscription is practically zero.
And the margins are expanding beautifully as a result, right? Their free cash flow margins are now exceeding 30%. They are throwing off so much excess cash that management just instituted a new $500 million share repurchase program.
Which is a critical defensive move for shareholders. High-growth tech companies traditionally issue a lot of stock to attract top engineering talent, which obviously dilutes the value of the shares you hold.
Yeah, using that massive free cash flow to buy back shares directly offsets that dilution. And they are executing this while maintaining a fortress balance sheet. They're sitting on over $2 billion in cash and short-term investments.
Against a very manageable $700 million in low-coupon convertible debt.
Now, to understand how they're driving that $3.8 billion in ARR, we really have to look at their sales motion, specifically a massive driver called the Falcon Flex program.
Oh, Falcon Flex. It completely redefines how enterprise software is sold. It essentially acts like an all-you-can-eat buffet for chief information officers.
Because in the past, if a company wanted to add a new layer of security, say, identity protection or a cloud module, they had to go through a grueling procurement cycle.
Budget approvals, red tape, just massive friction. Falcon Flex removes all of that by giving clients flexible access to the entire portfolio under one licensing umbrella.
So the friction is entirely gone. Once a client is in the ecosystem, they can essentially upsell themselves by trying new modules seamlessly. They use what they need, and the billing adjusts. It is incredibly efficient.
That brings us to the Catalyst timeline. Fundamentals tell us where the company has been, but the Catalyst calendar tells us what could act as rocket fuel for the stock over the next 3 months.
And there is a lot of fuel loading up on the runway right now. The most imminent concrete event is their Q1 fiscal year 2027 earnings report.
Right, and the consensus expectation on Wall Street is a strong top-line beat, specifically driven by exactly what we just discussed, Falcon Flex adoption accelerating their net new ARR.
Earnings are the ultimate reality check, obviously. But beyond the corporate calendar, we are tracking some significant macroeconomic and geopolitical tailwinds. Like, the market is currently pricing in hopes for easing geopolitical tensions, specifically around potential Iran deals.
And when macro tensions ease, the overall market risk premium drops. When that happens, you instantly see an increased institutional appetite for high beta growth software stocks.
For anyone unfamiliar, high beta just means the stock tends to move with much more velocity than the broader market. When risk appetite returns, capital floods into these names.
Plus, add the broader AI spending megatrend on top of that. Every major Fortune 500 corporation is frantically building out their AI infrastructure right now. You absolutely cannot deploy enterprise AI without securing the workloads.
Yeah, and that exact dynamic is going to be a major theme at the upcoming Princeton Corporate Governance